for early stage pay-as-you-go companies in the off-grid energy sector. Thank you all for registering to this webinar and for dialing in today. It's great to see that we have quite a number of attendants also on this second webinar. My name is Frida Pettersson and I work as a finance advisor for the Power Africa off-grid project. Short background to the Power Africa off-grid project. It's a 4-year program funded by the USAID. And we provide technical assistance and targeted grant funding to support the development of the off-grid solar home systems and the mini-grid sectors in sub-Saharan Africa. We work in a number of areas, including access to finance, business performance, market analysis, and energy policy and regulations. And we are also active in other cross-cutting areas, including gender integration and productive use. So today's webinar is the last webinar in this series on financial modeling that's hosted by Power Africa. And in the first webinar, we introduced a new financial modeling tool, and our presenters walked us through the mechanics of the different parts of the financial modeling tool. And so today we will build on that and add on some analysis that's key in the capital raising process. And the tool that we are referring to actually has several components. So one part is the Excel-based financial model, and that also comes with some additional Excel spreadsheets that we will go through today. We also have a separate step-by-step user guide and a video recording that's there to help navigate the model and the Excel spreadsheets. All parts of the tool will be available to download on the Power Africa website, and we will be sharing the link to the website by the end of this presentation. I should also mention that this webinar will be recorded, and we will be sharing the recordings of both webinars with everyone. So if you weren't able to listen in to the first webinar, you have another chance to catch up on the content at a later point. You'll also have the opportunity to ask questions to the presenters today, and we'll have a chat box open during the whole webinar, and you can post your questions there. And the questions will only be visible to the presenters of the webinars. We are a lot of attendants today, and we have set aside some time at the end of the webinar where we will be answering questions. The topic of today's webinar is using your financial model to conduct analysis that investors believe in. And it will be presented by Ivar Stoltz and Tokam Gufunke of Persistent Energy Capital. We've had the pleasure to work with the Persistent team to develop this tool over the last couple of months. And Persistent is an early stage investor and advisor in the off-grid sector. And Eva and Tokam both work as venture builders at Persistent. And they have many years of experience of working with early stage investing and also scaling impact businesses. So we are very excited to welcome them back and hearing them speaking on the topic of financial modeling today. But before handing over to the Persistent team, I would also like to introduce Lovemore Sevini. And Lovemore is an off-grid specialist with the Power Africa Coordination Office with USAID. And he will give some introductory remarks to this webinar. So very welcome, Lovemore. We appreciate that you could join us today.
Thank you, Frida, and good morning and good afternoon, everyone, depending on where you're located. As Frida mentioned, my name is Lovemore Sevini, and I'm an off-grid specialist with Power Africa's Beyond the Grid program. For the benefit of those who might not be familiar with Power Africa was launched in 2013, and it's a US government-led partnership focused on doubling energy access in sub-Saharan Africa by the year 2030. This partnership is coordinated by the United States Agency for International Development, commonly known as USAID, which is where I work as well. But it has other 12 different USG agencies, which are United States government agencies, 19 development partners such as the FDB and CEDA and many others. Also, we also work with over 150 companies and investors in the private sector, which is, I think, where most of you are coming from. As you all know, that it's estimated that we need about $660 billion to achieve universal energy access on the continent. And we all acknowledge that's way too much money for governments alone to come up with, especially with competing priorities in most African countries, as we know. And so really the overarching purpose of Power Africa is to unlock more private investment in Africa's energy sector. Now we know that our electrification in Africa won't follow the same path as we've seen in other parts of the world, because due to its size, there are too many rural villages that are located from major roads and making traditional grid extension unrealistic for the foreseeable future. And this is why Power Africa recognizes off-grid electrification as a critical ingredient for universal access, energy access in Africa. So when Power Africa was formed in 2013, there wasn't the Beyond the Grid sub-initiative, but in 2014, it was realizing that the situation that I just mentioned regarding the rural villages and the grid extension challenges, this sub-initiative called the Beyond the Grid was formed, and so that we move the off-grid solar market closer to commercial sustainability. Our approach obviously is private sector driven. To date, this initiative, the BTG initiative, has helped to deliver first-time energy access to over 16 million homes and businesses. We have made a lot of contribution to the off-grid sector, and these contributions quite many, and we have examples such as the grant fundings to solar home systems companies to innovate and expand their businesses, transaction support to unlock debt and equity, as well as grant funding, free business advisory service like the CFOs support and the CEO. We've done market assessments as well in about 10 of the countries that we call our focus countries, where we have our advisors in place. And these are also available on the Power Africa BTG website. Other activities include also guarantees to incentivize local banks to lend, and the list goes on. But today, as Frida mentioned in the introduction, we are here to talk about a new contribution that we are putting out to the off-grid sector, which is the financial modeling tool. I'm not going to go into the technical details. Our esteemed panelists will do that, and we'll have plenty of time to do that. Over the years, we've seen many solar home system companies that have great product and great vision, but they're unable to translate that into investment capital. And right now, especially the investment capital is tight, especially the challenges that came with the coronavirus, and companies are having to compete harder than ever. So one of the best things a company can do to increase their odds is to develop a sound financial model that can be presented to investors to provide funding. Financial modeling in the solar system PAYGO sector is not easy. You're often dealing with strong currency fluctuations, unpredictable tax regimes, high levels of risk in the various markets that work in, distribution challenges associated with expansion into new companies. And we know as Power Africa that this is hard. And we know not everyone in the off-grid sector has the deep financial expertise or pockets needed to develop a model from scratch. So really what we're trying to do is to make your jobs easier by giving access to an open source tool that will help you, amongst other things, to analyze your operational costs, do forecasting, and paint a fuller picture of your company so that investors know everything they need to know to arrive at a decision to provide you with funding. So I encourage all of you to put the tool to use, share with your contacts, and as Frida said, it will be available on the website. The link will be shared, I think, with all participants, since we have your emails, and let's take advantage of this new Power Africa resource. Thanks so much, and I will hand over back to Frida.
Many thanks, Lovemore, for the remarks and also the background of Power Africa's great support for the energy access sectors over the last couple of years. And with that, I would like to welcome the Persistent team to start the presentation. And once again, welcome Eva and Tukam, and over to you.
Thank you very much, Frida. Thank you, thank you for your comments, Lovemore, and thank you everyone who's attended. Quite excited to see so many of you have taken the time to join. We would sort of dive sort of right in. And the first thing, of course, with all these things is just kind of what's the point of this particular webinar, right? We had the last one before, and the big point really here is that at sort of one level is just a logical follow-on to the last one, right? For those of you who were able to attend the last presentation webinar, what we essentially covered there was just kind of how do you get this model, right? What is it sort of more this tool about? How do you get it up and running? And did some demonstration around that, right? But the big kind of outcome for that one was, allowing you to set it up, right? Have projections, which investors care a lot about, right? But this one is really looking at, now that you have this projection, a bit of so what, right? Like, I think as Lovemore was saying, right, raising money is a tough thing. It's fairly tough given the COVID context. And one of the things that with that this can be helpful with is essentially providing insights that can help you with your engagement with investors, whether they're debt or grant or equity investors. And what it does specifically is that, and I'll take you through, is looking at unit economics, right, sensitivities and valuations, right? Those are things that investors particularly often care about, often more than that, but that's usually like the bare minimum that they would want to be able to discuss with you. And the good thing with this sort of tool is that, even if you have that discussion, and that means revisiting certain assumptions, right? When you do that, again, that the unit economic sensitivities and valuations are updated automatically. So I will proceed next now to just, again, high level of what are we going to be doing, right? What we're going to do is that we will, and I'll do that, soon enough. We will recap, right? For those of you who missed it, just give you a bit of a taste of what we covered last time. We follow that with looking at those sort of particular analysis that we believe investors often want at the very minimum. Then we will talk a bit about some best financial, modeling practices, and then we will then go into Q&A. From a recap perspective, right? What did we do last time? We essentially did three broad things, right? One, we introed the tool, right, which I think Frida mentioned, and I think Lovemore touched on that. It's an Excel-based tool, right, that is available for download on the Power Africa website, and it also comes with a user manual. So in addition to these webinars that we're having, the last one we had, that manual is meant to help you, wrap your head around the tool and use it. So we did an intro of the tool. We discussed a bit of the flow and structure, and then there was a demonstration, largely led by my colleague Eva. From an intro of the tool perspective, right, we looked at a couple of things. One was just why the tool, right? What are the key components of the tool? What are some of the key things we took into consideration, which we're calling functionalities, right, for the tool? From a wider tool perspective, right, there's sort of two parts to it. I think part of what I think Lovemore mentioned, right, that it's a tool that's meant to provide you, I would believe lots of you are on here, entrepreneurs or potentially investors, ways to understand, just the dynamics, right, of that sector, when you're trying to build a PAYGO business, or what are the things that you need to be thinking about as you do so, right? And then the second bit of that, for the tool, why was essentially, again, the hope is to drive more investment in the sector by essentially providing what becomes a benchmark tool. But beyond that, I would imagine as sort of a business, sort of, startup owner or founder, you're essentially looking for something that, we believe helps you in driving more sound financial management. That is helpful both internally and externally. An internal perspective is you as a decision maker. How do you, what does the model tell you to help you make better decisions, but also as you engage with investors, right? What are some of the things you need to be aware of, and what information does the model, give you, or tool give you that can be helpful in that respect? The second piece to that was, we then looked at saying, okay, now that we have a sense of who was this for and why was this created, what are the main parts, right? And that first webinar focused a lot on what we call the main components. So that's, the assumptions, that's the micro model, and the dashboard. Then there's the part we're going to cover today, which was essentially the analysis, right? As we said, that are particularly important to investors. Once you've understood, put in the assumptions and all those calculations have been done, what do you learn from that that can help you as you engage with investors? That's what we're going to cover today, in addition to some add-ons, right, to help you maybe simplify and as you communicate with others about your business. In addition to, if you have a business, for example, that has more than 5 products, what do you do in that case? So we covered those components, right? And then we looked at some of the key considerations of functionalities as the model and the tool was being built, right? One of the things, remember, a model, you try to capture as much reality as you can, but then there are always trade-offs, right? So in terms of things, we try to make sure we reflect it, because we see it as investors that's often overlooked, is we did detail month to month, right? That's what the model tool does, detail month to month financial statements. And when I say financial statements, typically investors want to see your profit and loss statement, they want to see your cash flow statement and your balance sheet statement, right? Again, any kind of investor typically wants to see those through. So those basics were covered, but what I think was new is we did it month to month, because a lot of what we tend to see is sort of an annualized view, which as an investor often can hide things you want to see. The next thing we took into account, which is often overlooked, is the currency effect. As you might know, for those of you who already have your business up and running, what tends to happen is that the currency in which you're earning as you sell to your customer is not often the currency in which you're buying what you're selling, nor is it the currency in which you're borrowing money when you start looking at leveraging debt to grow your business. So that is something that the tool we talked about takes into account. And then the other one was sort of accounting kind of standards, right, or methods. Is it cash? Is it accrual? We talked about how cash tends to be what investors like to see, because they like to get a sense of how much cash is actually generated, whereas accrual often doesn't show you that. But it's not something, some countries allow you to do both, right? So some of the things we talked about the pieces, how it fits together, and my colleagues, as I said, did a demonstration around how do you populate the inputs, and remember, the inputs here are your assumptions, and they were in different categories. They're essentially product assumptions, they're customer behavior assumptions, they are financing assumptions, they are balance sheet starting point assumptions, right? Again, I think Frida said this, it's worth doing. I think they've sent that out, the link, worth watching that first webinar. But this again is just a recap of what was covered, which you can watch in that webinar. But most importantly, the tool is something you can download, and there's a user manual that comes with it, right? So that these webinars are meant to supplement the user manual, but we highly recommend that you use it as you use the tool. Next, I said, look at, again, what we're covering today, right? The main model bit on the left, that's what we covered in that first webinar, and that's what I've just recapped. What we're going to cover in this webinar are, sort of what we call additional analysis, but these are really analysis that investors tend to be very focused on, in terms of quickly understanding whether your business is one, that can be sustainable, and also, what kind of, investment might they need to be looking at. As I said, in addition to that, we will, present you with a tool that is an add-on that, it's a simplified view of the business that makes it much easier to communicate around the business, and also some additional product sheets. Now, starting with that first one, right, unit economics and, what we've called profitability milestones. Let me explain, right, what is unit economics? What do we mean by profitability milestones? Those are linked. That's why we're talking about them together. Unit economics, kind of interesting, literally means, right, the economics of a unit, right? The idea is that you want to get a sense of what are the economics of one unit of whatever you are selling. Now, when we say economics, it means at least two things, right? It's saying to get a sense of when you sell your product and you've paid the cost of that product, right? How much of that revenue you generated is left, right? That's what you call your gross margin, right? That's one of the elements of unit economics. The second element is what you call the margin, contribution margin. That goes a bit beyond gross margin, which is your direct cost. It looks at saying, look, once you've paid for the price or the cost of whatever you sold, if you take out what it costs you to get it in the customer's hand, right? What share of that money you generated initially is left. So an example might be, you sell something for $100, using the dollars as an example, and you have a customer who pays, who pays 10, $100 for that, right? It costs you, let's say, $50 to buy that thing, right? From a unit economics perspective, your gross margin is $50, right? Essentially saying that's 50%. When you've taken out the cost from the revenue, what is left? And why is that important? That's important because as a business, that's what you're left with to cover pretty much everything else, right? To cover your operating expenses, any debt you might have taken out, and any taxes you might have to pay, right? Any sort of like taxes on, from your operating profit if you have one at that point. So that's one of the things that we tend to care about, and the thing we here as investors, in that we want to make sure, is this business on a unit basis of what you're selling generating enough, sort of like leaving enough cash after what you must pay has been paid for. Then, in the particular model, the way it looks like is that we provide you with the unit economics for each of the products you are selling, as well as some sort of a blended view, what we call portfolio unit economics, right? That across the different units you are selling. Now, profitability milestones, the next thing we'll talk about, and I will sort of demonstrate this when I'm done with this. Now, profitability milestone, here are just things where investors tend to look at to get a sense of how quickly might you be in a position to become sustainable. So it's largely around timing. One of the things that they tend to look at is to say, look, do you have a positive EBITDA? When do you have a positive EBITDA, right? A sense of, when might you need support till you become positive, right? Is your net income cash positive? When does that happen? Right? When do you become, cash break even on a cash basis? And that again will cover. And why is this important? Because it gives investors a sense of, well, if I decide to put in money here and all the assumptions you've provided me with, if we agree on them, right, it gives me a sense of, okay, when might this thing begin to be in a position where potentially, if, for example, I'm a debt investor, I might start, it might make sense for me to invest. Or if I'm an equity investor, right, where might it make sense for me to stop putting in equity and start, working with you perhaps to raise debt or something of that sort. So again, this is why, again, these are important, right? This is why unit economics is particularly important to investors. It's the way to get a sense of, once you've paid for the things that you must pay for, is there enough often left to cover the other things that you have to cover as a business that is a going concern? Now, I will, just show you here uh, a demonstration, right, in the model of what that unit economics I just talked about looks like. Remember, at this point, the assumption is that, you have populated the model, you've put in the assumptions that you needed to put in, and everything is good. Now, what does this say about unit economics, right? Let's look at product 1, for example, and product 3. Right? You see product 1 is an example of a cash product, right? You sell this thing to somebody, they pay you 1818, right? There's no, there's no contractual payment after that because it's a cash product, right? It means that what you've made from that product is 1818. Let's pretend that this is in Kenyan shillings since we're Kenya. And then now what, this is sort of what we say PV of receivable. I will explain that when we talk about product 3. The idea is to say, look, what is the total amount of money you will collect from this product today? When you do that, it says, look, for this product, because you paid for it in cash, it was bought in cash, right, from your customer, this is what you're earning. Then you look at, what exactly is it costing you? Again, this is just picking up from the assumptions you would have put in, right? Saying, look, for this particular product, it costs 923 shillings to, buy it. And this is the fully loaded cost, right? This is looking at the cost of the item, the shipping, sort of any sort of like import duties, getting it to where it needs to get to. So that's this, right? Then, of course, now, as I said, remember unit economics, there are two elements to it, right? There is the, gross margin, right? Which in this case is 49%. You see here, this is essentially saying, if I take this 1818 and I take out this 923, how much of that 1818 is left? This is telling you 49% essentially of the revenue you collect is left to cover other costs, typically your OPEX. Contribution margin, as I said, goes a bit further. It's looking at saying, okay, true, right? There you've spent it's cost you 923 Kenyan shilling for this product, but you had somebody who sold it to the customer, right? If you're paying that somebody a commission, in this case, you're paying them 52 Kenyan shilling, right? That has to be taken out because that's a cost in selling that product, an immediate cost. The other thing you need to take out here, which model does for you, just showing you, what is taken out, is the direct variable cost. So in some cases, for example, if the customer, let's say, paid by mobile money, right? There might be a mobile money charge that you decide to incur as good business practice. That has to be taken out, right? When you do that, now there's 44% here saying, out of the 1818 Kenyan shilling that you collected from the customer, you are left with 44% of that after you've covered the direct cost of that item, but also the cost of the salesperson who, what you pay them in commission and other direct costs like bank charges and call center. For example, if the customer had to call in to, make up their mind to make that decision. Now, let me show you a different variant of that, which is product 3. Now, product 3 is probably more of the kind of business you'll be setting up, right? Where essentially there's a down payment, right? 1,000 here. And then there's a contractual agreement where the customer is going to be making 400, in local currency, call it Kenyan shilling, and they will do so over 30 months. That's what this 30 is, right? Again, these are all things you would have input already at some point. This is just sort of giving you a unit economic view of your business. Now, in this case, because reality, right? Sometimes people don't have money to make payments. You're probably not going to be collecting all of that money that was due to you contractually, right? In this case, the assumption was, hey, you're collecting about 85% of what you're supposed to collect, right? And then that says, well, based off that, this is what your expected revenue you'll be collecting every month is over the next 30 months to 340. Now, again, in most markets, right, VAT, you have to exclude VAT because VAT is not something you keep. VAT is something that goes to the government. So when you adjust for VAT, this is essentially what you're collecting contractually every month from the customer. Over these 30 months, right, like if you were to look at this, you would think like, okay, this is what you're collecting. It's essentially that down payment plus the 309 times 30, right? That's typically what people do. One of the things we realize is that, well, the truth of the matter is money, collected over 30 months, window from now is not the same as having it today, right? So there is the time cost, time value element of money. My colleague would talk about this, Eva, when she talks about valuation, where this number comes from, but there is a time cost to money, right? If I were to tell you today, I will give you $100 today, or I'll give you $100 in 30 months, you probably want that dollar today, right? That's the idea behind the time value of money. And it's saying essentially that you have to adjust that payment you're expecting over time because you're effectively financing, right, that purchase over time. Right, you're financing with a combination of equity and debt, and my colleague Eva will talk about this a bit when she talks about the valuation element. And that, based on that, let's assume in this case that the cost of capital was about 19%. Then the present value of those 30 payments you're expecting in the future today, right, is 8371. Think of this number as a number saying, if I came to you and said, look, I want to buy that customer's receivable from you, right? What is the lowest you'd want to sell it to me, right? Given what it's cost you, right? That's what that 8371 is. And you can see that it is lower than this 10273. And the reason is, again, there's a cost to the time value of money. If money was free, right, and it would be zero, those two numbers would be the same, means there was no risk essentially, right? To collect to that money, to collections, you would have the same number. Now that it says, okay, this is what that the unit revenue today is, right? That's the total present value of what you were supposed to collect. That's what it's today. Similarly with the other one, right, there's, if you want to get the gross margin, you take out the immediate costs, right, fully loaded cost of that item. And in this case, this 55%, again, as I said before, is telling you of that 8,371, 55% is left once you have accounted for, right? You've taken out what it costs you to buy, right, ship, and make that thing available to the customer. Now, the next number, as I said here, which is the contribution margin, this is saying, look, again, of that 8,371 that you've collected, or the value today to the, to you, if you take out not only what the item costs, but you also take out the cost of making it available to the customer. So commission, for example, by a sales agent, and any other, direct cost of making that item available to the customer, right? You're left with about 48% of that is left to cover your other costs, right? One of the things that I would then do now, if you look at this, is to say, if I was an investor, I would say, well, it does look like product 3 is, one of your best products, right? The gross margins seem pretty decent, as does the contribution margin. So, you might want to test and see, hey, before we do that, if you look at this column J here, this is what the weighted across your portfolio. So this is essentially telling you, if you kind of aggregate across the 5 products, right, what does that unit look like, right? So in this case, if you kind of aggregate using sort of the mix of volumes you're able to sell, right, your gross margin is about 52, your contribution margin is about 43. Now we'll do something and say, look, you know what, you realize after doing this, like, wow, product 3 is great, right? Let me see how I can sell more of that. You come up with a strategy to sell that, and then you're able to, it becomes a hot cake product, right? It is growing a lot faster than everything else you have, right? What does that do to your unit economics, right? If you're selling more of the product that is, higher sort of margins, what this model does is that if you click here, just to see for all the years, you can see that your margins improve, right? If you remember, they were somewhere around 52 and 43, but as you can see over time, given the kind of strong growth rate that, you've managed to figure out a way to sell way more of product 3 than everything else, you see that your margins are getting closer and closer to what it looks like for product 3, because it's becoming your dominant product. So it's a lot of your weight in your portfolio on a unit basis is shifting to product 3, right? These are some of the things that, again, insights that you can start to think about, right? To see, hey, if I have this particular product that's particularly, good margins, are there ways to sell money? If I'm able to sell more, how does that affect my position? Now, the other thing here, so, I will do that. And then I will then sort of take you through, quickly just show you, the other thing here is, what we call new sales, right? So what the model also allows you to do is to see, look, every year that is modeled, what do your new sales look like in terms of unit economics? This is important because, over time, for example, it could be that you have a business where you started out selling things that might be low margin, and you're looking at shifting, you're selling something new, right? This can help you look and see, look, is what you're selling going to help, the new thing going to help or hurt your current unit economics, right? If you're selling more of things that are lower margin, what you probably see is that, your new sales, right, unit economics would look lower. And that's sort of telling you, like, if you keep selling more of the new things you're selling, you're going to be depressing your unit economics, which might raise questions around how sustainable might this business be, because remember, unit economics tells you how much of your revenue, on a unit basis available to cover all the costs, right? So now let me tell you a little bit about those other costs, right? So one of the things, and this is sort of that profitability milestones we talked about, when you look at uh, when you've put together your financial statement, one of the things that, again, investors look at is a sense of how well is your business doing, again, typically cash basis, right? Whether it's net income or EBITDA. You can see in this particular case that given the inputs that were put, it looks like it's a fairly good business, right? That it's EBITDA positive from day one, right? Essentially what this is telling you is that your business is able to generate enough cash to cover the cost of what you're selling, the direct cost of that sales, and your OPEX cost, right? Like that is something that, over time, investors like to see as positive. right? Same with your net income, right? Investors understand, look, there's probably a time when, probably a good amount of time when it's going to be negative, but at some point investors want to see it become positive. Like you look in this particular case, you see that it becomes sustainably positive right around 2023. Right, that around then there's a sense that, look, if everything has happened as planned, your business is going to be one that is going to be cash positive from a net income perspective. The second set of things that I will talk about touches again on the unit economics, as in saying, look, one of the things that investors want to look at is to say, okay, you've sold these things, right? Are you generating enough cash to cover your operating expenses, right? That's what operating break even is. Essentially saying, once I've sold something, if I take out my operating expenses, is there much left at all, right? And one of the things to keep in the back of your mind here is that this, for example, when you see the OPEX here says, for example, let's say by year 2023, it's at 60%. What this is telling you essentially is that whatever it is you are selling, if your contribution margin is more than 40%, you have a problem, right? This is what this tells you, right? So another thing investors look at to say, okay, if these are your operating expenses and your OPEX break even is say 60%, this tells me that whatever you're selling, if your business is going to be sustainable, should not be more than 40%, right? Because remember, this is what is left after you've covered your OPEX. And traditionally would mean this is what should have gone to covering the cost of the item you sold and the direct cost associated with sales of that item. Similarly, one thing that is here is, cash break even for OPEX and debt, right? This is typically looking at like, well, if you sell something, and this is an event, for example, where you've hit a rough patch, you're trying to make sure that your business stays open, you're mostly generating revenue from units you've already sold. You're not selling anything new, right? This becomes helpful to see, well, if you stop selling today, right, going forward, and you're just making money from whatever is in store, right, you've already put out there, can you cover your operating expenses and your debt obligations, for example, if you've taken out any debt, right? That's what that one tells you. Again, remember, all of this stuff is going to be in the manual, right? You're going to be able to see what these things mean. The last bit here before I hand over to my colleague, Eva, is just around the cash break even. This is essentially looking at when everything is taken into account, right? Is there anything left? And you see in this particular case, right, it's negative, but it's close to zero, right? It's 6%. That's often what you want to see as an investor. Is this thing at some point becoming less and less negative, and eventually does it become positive, right? Because if you have a business where this is constantly negative, it means somebody must be funding it. Because remember, one of the things with a business is you cannot operate on, at the end of the day, your total cash flow cannot be zero, right? If it's negative, it means somebody has to step into fund with something, right? As I said, again, these things, right, we invite you and really encourage you, right, rewatch this webinar when we're done, but also go through the manual, because a lot of these terms are defined there. And if there are questions, right, you can always sort of pose them. I will now hand over to my colleague, Eva, who is going to, take you through the next bit, which focuses on valuation.
Thanks a lot, Tukam, for this. So now I would like to start with one of the other key values actually that are interested to investors. And before taking you through the valuation calculations in the model, I would like to share some general thoughts on valuation. So generally a company valuation can be conducted using different methods, and some of the most commonly used ones are the transaction multiple method, which is either the revenue multiple or the EBITDA multiple. And then there's also a simple rule of thumb, which we call the Silicon Valley rule. And then another common one is a discounted cash flow method. So given that each of these methods comes with its own advantages and disadvantages, we suggest that companies compute the value using a mix of methods and also apply premium or discounts where it's needed for a basis, where needed for as a basis for the negotiations. And then, of course, in reality, in addition to these more quantitative methods, there are often also some soft factors that play an important role in evaluation, especially for early stage companies. And these can be, for example, the previous round valuation, the ownership of the founders, the quality of the management team as well. However, many investors, they do conduct valuation exercises using more quantitative methods. And so it is important for entrepreneurs and companies to understand what the most common ones are and which parameters have the most impact on the valuation. And also what happens often is that investors and entrepreneurs, they already have somehow a valuation already in mind. So basically seeing how high and low certain assumptions have to be in order to get to that specific valuation using traditional methods also helps to get a sense of whether the valuation is in a reasonable range or not. And the last thought I'd want to share is also that when proposing a valuation, early stage companies should also keep in mind that it is not only about maximizing the value, because there will be a fundraising round again in the future. And what you want to avoid is also to have a down round. And so what we have done in the model is to include a valuation sheet where we exemplified some of these most the key methods basically. So the first one is the discounted cash flow method. You can see it here. So this basically provides the value of a company today based on the cash flows that it is expected to generate in the future. It is not an ideal method for early stage companies because it is highly dependent on assumption, and therefore it works best when a company has enough historic cash flows to make some realistic assumptions around the future. It also does not work for a company that produces negative cash flows. And here, just to show you how it's incorporated in the model. So basically, the yellow input fields, again, is where you need to provide some values such as the amount of debt at the moment of valuation, the cash available, then also some assumptions to calculate the cost of equity. So here again, the model includes some instructions on how to get there. And then basically based on the other inputs that you provided on your unit economics, on the OPEX, etc., the model automatically calculates the discounted cash flow and then takes the cost of capital to derive the value of the company. And here you can also apply some discount. So for example, what is a common discount applied for non-public companies is the liquidity discount. Again, like here, most of this is, all of this is actually commented in the model, so you will find the relevant instructions. Then another method that is very often used is the transaction multiple method. So this method basically assumes that similar assets sell at similar prices. So to determine the valuation, one should look at comparable companies in terms of size, geography, business model, etc., and then apply the same multiple to its revenues and the EBITDA. So for example, if in a certain industry, the companies have a multiple of 5, that means that its value, or like an EBITDA multiple of 5, that means that its valuation should be roughly 5 times its EBITDA. And then even here, often, first of all, it's very difficult to find comparable companies. So you can also apply certain discounts to take into account, to take into consideration differences between different companies. And another difficulty with this method is that it's often very difficult to find available data, actually. So it's easiest to use when you actually have a set of comparable companies that you can access. And it also does not take company specificities into account. So basically, even here, some judgment needs to be applied definitely. And then the last one is a very simple rule of thumb, which we basically call the Silicon Valley rule. And this is often used especially for early stage companies, also for pre-revenue businesses. And it basically says that as a rule of thumb, a company should give away roughly between 1/3 and 1/4 of its shares at every investment round. So basically, as an example, you can indicate here how much you are planning to raise, basically. So say you want to raise 2.5 million and you want to give away 1/3 of the shares. And that basically means the implied pre-money valuation, that is the valuation before any additional injection of capital, should be roughly 5 million. This way, you basically, after the fundraising round, or the new investors get roughly 1/3 of shares. And then what this sheet does as well is that once you provided all the inputs below, it shows the range of values obtained with each method in the so-called, we call it a football field chart. And then what you can do is you can assign certain weights here. So for example, if it's a very early stage companies, the weight assigned to the discounted cash flow would be minimal. And then it calculates the average valuation, the average implied pre-money valuation, basically. And yeah, as said, there is not one right method to value a company. This is more to show what the different methods are used, and also to sense check whether the valuation falls within a reasonable range. Then what we also included in the main model is so it's another analysis that is relevant for investors. It's the so-called sensitivity analysis. Basically what this does is that it enables you to see how some target variables are affected based on some changes in input variables. So in other words, it shows the impact that certain inputs have on certain outputs. And I'm going to show you one example here. So basically, our output variable here is the net income generated in 2025. And then you can see how does this change based on a changing month-on-month growth rate and based on the collection rate. And what it tells you is that if your month-on-month growth rate is 1% and your collection rate is 75%, then your net income in 2025 will still be negative. And however, if you have a higher month-on-month growth rate, say 4% here, and a collection rate of 85%, then your net income in 2025 will be around 2 million. So this is basically to show some sensitivities on some of the key variables. So this is the main analysis that we included in the main model. And then we also provided some additional tools, actually, which I'm going to take you through. I'm going to just briefly explain what these tools are. And then I'll demonstrate the Excel version of them. So what we included as well is a simplified business model tool. This is a standalone tool, which it's not linked to the main model, and it provides a very simplified presentation of the pay-as-you-go business model. So this can mainly be used to explain the business model to a third party, for example, an investor, in a way that is very easy and very simple to understand. And it can also be used to conduct a simple check of the business economics and the related required scale to reach break even. It's very easy to play around with the inputs and see what would be needed to reach a certain target. And then we also included an additional product sheet. So what we've shown you last time is that you can model up to 5 products in the main model, but sometimes you may have several product categories, and each of these categories has more than one product. So basically what this does is can be used to calculate the weighted average for the input values of 2 or more products, so that you can incorporate more than 5 products basically in the main model. I'm also going to briefly show you an example of this in a bit. So now I would just briefly show you the simplified business model tool. As said, it's like completely independent from the main model, and I'll just take you quickly through it. So say you have a down payment of roughly 10, you have a contractual monthly payment of 10, the collection rate. So again, here all the yellow cells are the input cells, collection rate of 90%. Then you have to pay the monthly installments over a period of 12 months. So this then basically calculates the total expected revenue per unit. Then you include the cost per unit, including the price, the freight, the duties, the clearance. So say this is 45%. And then what, as Tukam showed you before, you also need to consider the cost of capital. And the values I'm using here now are dummy values. It's just to show you how the tool works. So basically what this does then, it calculates the gross margin that you have on the single unit. And then you can indicate how many products you sell per month and what your number of active pay plans is. Say you sell 2,000 products per month and you have around 20,000 active pay plans. Then you can also indicate, so to calculate the number of employees, you indicate how many customers you have per FTEs. So say in this case, you have around 100 employees. Then you can indicate what the average life of the portfolio is. This is basically needed to calculate the present value of the receivables. So say this is 6 months. Then when it comes to the inventory value, you can indicate how many months of inventory you basically have. So say this is 3 months. And then as you see, as soon as you input the values, the model basically calculates in one column, just very simple, the P&L, the profit and loss statement of the business. So as you see here, it has calculated the cash revenues, and it has calculated the cost of goods sold that you have per month. Then say we indicate a certain percentage for the direct cost of sales. Then you indicate certain a salary level per FTE. You indicate a certain cost for the management, and you indicate certain overhead costs. And then it calculates the EBITDA. Then you can indicate certain depreciation of fixed assets that you have per month, and it calculates automatically the interest expense based on the values that you have provided here. And then the EBIT is calculated. Then you indicate the tax rate, and then you get the net income. So this is basically just showing you it's a very simple model of the business economics. And then what you can also do is you can indicate a certain EBITDA multiple, so that you get to this is applying the multiple method as I showed before. So you get to a certain company value. Here for simplicity, we have assumed that all installed assets have been financed by debt, and we have assumed a leverage ratio of 1. So basically this means that you have 620,000 in debt and 620,000 in equity. Then by subtracting the debt from the company value, you get to the equity value. Then here you can indicate, so you want to calculate the multiple on invested capital. So you can indicate a certain percentage, which we called here the dilution. So what you need to provide here is basically the average percentage that is still owned by all equity investors. And the dilution may be due to a number of reasons, such as employee benefit shares or sweat equity. And then finally, what it allows you to calculate is the internal rate of return. So basically the average growth, the yearly growth rate of the investment. And then you can indicate the holding period basically here, number of years, and then the IRR is automatically calculated. So as said, this does not provide for a detailed projection of EBIT and of company value, but it's really just to assess in a very simplified way the economics of the pay-as-you-go business. And then the other sheet that we also included is the additional product sheet. So I'm just going to show you very briefly also how that works. As you can see, so if say in one category you have like up to 10 products, you can provide the input values here, and then it calculates the weighted average across these values, which you can then use to include in the assumption sheet of the main model. So I'm just making a quick example again, but say you have 200 or 2,000 active installations of one product and 3,000 of the other product, then the number you sell per month of this product is 200. Here it's 300, and then you have a certain down payment per unit. Say for the first product it's 10, for the second product it's 15. Then you have certain contractual payment periods or number of months over which you have to make those payments, and then a certain monthly payment that you have to pay. I'm not going to go through all the inputs here, but basically this is just to show how the model calculates the weighted average. And then here you can see basically that what the down payment per unit is across those two products, what the contractual payment period is, and the contractual monthly payment per unit. And then you can use those values. And I'm just going back to the main model. The part that I showed you last time. So basically in the assumption sheet, this way you can incorporate the values, for example, in one of those 5 products or one of those product categories. And it basically, it's just a way to include more than 5 products. So these are the main components of the tool that we developed. And I've seen again, there have been a number of questions coming through. So I'll hand over to Frida again to take us through the Q&A session.
Thank you, Eva and Chukam, for this thorough presentation, and being able to communicate your business dynamics in a structured way, or structured ways like this, is definitely a valuable part of an investment pitch. And it's really our hope that this tool will be a good support in the fundraising journey for entrepreneurs, especially in this challenging context. Thank you also everyone who posted questions during the webinar. We have received a number of questions. Some of them are very similar characters, so I try to categorize and summarize the questions for Eva and Chokam to answer and give perspective to. But perhaps I start with a few administrative questions, and it's a couple of questions around the access to the tool and the webinars. And the tool is publicly available, all parts of it, and I think you can see the link on the screen right now. Also the recordings of the webinar and the most frequently asked questions with answer will be shared after this webinar. So if you missed anything, or if you want to listen in to this webinar again, you'll have the chance to do so. The tool is available in English only, and not in French. That was another question. Moving on to questions of a more technical character, and also related to the content of this webinar. We get a couple of questions around the flexibility of the financial model, especially on the Excel part of it. Some of you ask if this is an open model that can be customized further. And if it's possible to amend the model to incorporate more sophisticated approaches to, for example, OPEX and inventory modeling, and also if you can accommodate a multi-country context. And also related to that, a company dealing with euro asks if you can change the foreign currency from USD to euro. And I hand over to the Persistent team to answer those questions, and perhaps we can also touch a little bit of limitations on the tools and how to address that in this context.
Yeah, thanks a lot for that. So I think that the first question was whether it's an open model that can be customized further. Yes, it's definitely open. It can be adapted and customized by the user. And then the other question we got is whether a more sophisticated OPEX approach and inventory, I think, can be incorporated. And here, yes, you can incorporate that. And as mentioned, the OPEX framework that we have included is quite a simple one, and the inventory modeling framework as well. So basically, what you'd have to do is to link the output of the more sophisticated OPEX and inventory model to the respective lines in the VDED model to take that into consideration. And then the other question, I think, was around the currency. So per default, we included local currency conversion into US dollars. But basically, if you want to use a different currency, like say you want to convert it into euro, that works as well. It's essentially just the exchange rate that you apply. So the US dollar, say in this case, is the symbol that we use, but in case what matters for the calculation is the exchange rate that you apply. So, and then obviously if you want to change the symbol, that would have to be done manually. I think that, and I think one question was as well on the multi-country context. So what we have done here is to model a one country, or to consider a one country context. But what you can do is to basically recreate the model for the different countries that you're operating in. and then create a consolidated version of that, basically. But that would have to be done. That's not anything that's included automatically and can be done automatically with the model.
Frida, I can add a bit of just color to what I think Eva said, right? So when you, in some of the questions around so OPEX and inventory and it's a single country. So from an investor perspective, right, I think we often like to see, you know, almost a single country approach. Because one of the things that we like to see is, you know, when you look at a business, right, is it sort of profitable on the single country level versus, you know, aggregating? So I think, you know, you can always aggregate, as thing as Eva said, right, build for each country, then aggregate into a bigger one. But I think investors, at least like ourselves, we like to see sort of a single country, right? Like, how is it doing on that single country level? And on OPEX and inventory, the only thing I would add is that I think one of the reasons, and we talked about this in the first webinar, we didn't try to, you know, model everything, is that this is somewhat of your secret sauce, right? Like, you know, how your OPEX sort of, you know, how, what it builds on and how it grows, right? Is something that often that's what might differentiate your business versus another, right? So what the model tries to do is to say, recognize the fact, like, look, you need OPEX, right? Now, what those numbers turned out to be, right, and how it builds over time, that's something that, you know, it's a bit of your secret sauce, you know. But what model does is to say, look, once you've arrived at what those numbers should be, you can input them, right? Similar with inventory, right? Those are things that we see as largely your own unique sort of like differentiators, right? That, but we allow you to be able to input them once you've arrived at what those are on the basis of sort of what you see as your particular strategy.
Thanks, Ivan Chokam. That's very helpful context. And on a similar theme, someone is asking if the interest income can be presented in the model, and with the background that some investors and governments actually require transparency around a cash price versus credit sales.
Yeah, thanks for that question, Frida, and thanks for whoever answered. That's sort of, I think, a question that is quite interesting and a very good one. So the way it was built, right, it just allows you to put in sort of a lump sum, because that's typically what happens, right? That often the customer is not, you know, they don't sort of, when you're contracting with them, it doesn't say like, hey, look, Frida, you know, you're charged this much interest, right? So it's typically just a lump sum. But that being said, while it's not in the model, what you could do is just, there's a function in Excel called payments, right? What you could do with that is that you could essentially build a sheet that essentially does all of that. What payment does is that it allows you to put in, say, look, this is how much, you know, the cost to them is. This is what the down payment is. This is the interest you're charging. This is the time window of which you're charging it, and it's a monthly or whatever. That can tell you this is what the payments, right, like the monthly payments would be. So that's something that, while the model doesn't accommodate, again, because it simplifies to the extent that what you see in reality is that people don't tend to care that much about the interest. What they care about is how much they're supposed to earn, right? It's supposed to pay you, sorry. But if that's something that somebody wants to do, it's fairly easy to do in Excel, right? You just have to sort of create a new sheet where for each of the products, you look up the payment function and how it's used. It can help you do that, where one of your variables then can be, you know, that interest rate, where you set the interest rate to reflect the payment that you need it to be, and that can then help you be able to do what you're saying, whether it's to answer the question around what is the effective interest rate you're charging on this product, if that's something, I don't know, your investor or government wants to know.
Great, thanks for that. And on the same theme and related to formulas and inputs of the model, we also see some questions on if the tool applies standardized KPIs and industry-specific benchmarks. And again, someone asks about discount rates and what discount rates and numbers you're using in the model.
Yeah, I'm happy to take this one. So what we have included in the model is some of the commonly used KPIs and some of the ones that we consider most relevant, but these are not, yeah, it's obviously there is some subjectivity to it, and equity investors people want to see some different KPIs than debt investors, for example. And then when it comes to benchmarks, no, so the tool doesn't include any benchmarks. So basically, yeah, what we have included is there. Those are dummy values. So it's really, every company should look at its own business to calculate the inputs basically, or to make assessments around the inputs. And when it comes to the discount rates that we have used in the tool for the calculations, so even here we would advise to everyone to use the discount rates that make sense for your business. What the model does help you is that it helps you to calculate these discount rates based on some of the inputs that you provide on the valuation sheet and on the assumption sheet.
Great, thank you, Eva. And someone also asked about error checks that we saw you demonstrating last time in the main model, and how to check for error checks in the additional sheets that you presented today.
Yeah, so the error checks basically that we included in the main model are the key ones, and they are actually all related to the detailed model, to the detailed month-on-month projections. I think for the additional sheets, such as the valuation sheet or the simplified model sheet, I think it's easier to basically there are not that many different sheets that flow into it, so I think there it's easier to assess yourself whether there's any mistakes. But mainly, I think the error checks, what they do, for example, for the detailed model, is to check, okay, do you have positive cash flow? So for example, say if at some point you indicate that your business is growing at a higher rate, then at some point it will show errors because your cash flow is becoming negative. That means that you actually need to raise more funds than that you have planned to. So yeah, but those are mainly related to the more detailed calculations.
Thanks for that. And a few of you have also asked if the financial model has been approved by any financial institution or investor. Perhaps I just start here to provide some context of the tool related to this question. It has not been approved, so to say, by any financial institution or investor, and models rarely are, I guess. It's developed with best practices in financial modeling in mind, and also taking some very sector-specific aspects into account, but it's not a guarantee of a certain outcome. It doesn't give you, a set of company value or a certain accuracy of your projections. But perhaps, Eva and Turkam, you can take us through a little bit around how you have developed it and how you have thought about the process of the development of the tool, basically.
Yeah, yes, thanks so much, Frida. So I think Frida sort of hits it right on the, the nail on the head, as they say, because what you need to realize with this is, like, any investor you go to, right, they would have a base set of things that they want to see. What the model does is to provide you with some of that information, right? Remember, a model is only as good as the assumptions. So, wherever you go to, whether it's a bank or another or investor, equity investor, right, there will need to be some kind of agreement around, do I believe the assumptions you've put in this thing, right? And that's typically now where, to Frida's point, it's something that what it does is to give you information that you can use to engage, right? You can go to an investor and they tell you, look, I don't think that product, as I was showing earlier, is going to grow. You're going to be seeing, 500% growth over the first year. I think that should be more 100%, right? What the tool helps you with is say, fine, if we agree on that, I'll change that to 100% and see how that affects the outcomes. Now, that being said, in terms of process, a lot of what we did was that We engage with CFOs, right? We engage with the industry. We had quite a bit of engagement with Get Invest, right? They provided quite a bit of feedback. We had also feedback from E&Y, right? The global consulting firm, right? To make sure that this thing made sense, not only from a professional's eyes, but from a practitioner's eye, and also engage, as I said, with CFOs from people who might be actually using this model. Right. And I think as Frida said, remember, it's a model, right? A model is meant to help you garner insights about reality based on what you've assumed, but no model in the world is ever perfect, right? It's not supposed to be something you take to go to a bank, right? It's something that helps you talk with the bank, but the bank will not, on the basis of the model alone, do anything with your investors.
I think that's very helpful to know. We also have quite some questions around the financial analysis and the different valuation approaches. And perhaps I start with actually from an investor perspective, what are the key factors in terms of analysis and kind of key KPIs that investors are looking for in a financial model? And I think you touched on this a little bit, but perhaps you can give some insights also on how this might differ between an equity investor versus a lender, if it differs at all.
Yeah, thanks for that. So I think when it comes to what are the key analysis that you'd want to see, so the most important one is definitely the financial projections and how these changes, you make changes to some of the inputs, then also being able to assess. So I think that the objective of the model is not to be extremely detailed, but what you want to see is what are the sensitivities to certain key parameters, and that's definitely something that investors will want to look at as well. Then I think what is very useful is also to have a comparison of different scenarios. So any party that looks at the model can make up their mind basically on what they think is the most realistic scenario. Then what we always find very important as well is what Tukam has showed earlier, is what are the unit economics, like because this basically tells you a lot about the potential of the business to generate profit at scale. And then I think the other question was, what are the critical KPIs? So I think that's another aspect that investors like to see in a model, is the evolution of those critical KPIs. Also, what are the critical KPIs considered by the company? So what are the things that they track and measure? And I think there's different categories of KPIs, and we have included those actually in the model. Some are the key financial metrics, such as the evolution of the EBITDA, the evolution of the net income, the cash break even. Then what's also very relevant are portfolio quality indicators, such as, for example, the collection rate. And then also obviously the impact KPIs. So in the case of solar PAYGO companies, that would be the tons of CO2 replaced and the livelihoods improved by providing access to energy. And then on your question around how this might differ between debt and equity investors, I think some of the variables that debt investors in addition are also interested is basically the ability of the company to service the debt. So for example, a debt service coverage ratio or a cash to debt services ratio. I mean, very often what debt providers do, they give you certain covenants, or they indicate certain covenants, which are the so-called rules that the company needs to adhere with, basically. And we also recommend, I've shown that last time, to also include those covenants in the model, because then as you change some of the inputs, you immediately see also what the output is in terms of those covenants. So yeah, I think that's mainly the key indicators that we'd include typically.
Thanks, Eva. And we also have quite some questions on the unit economics theme presented today. And this is quite a broad questions, but one participant asks what are the newest ways you're seeing to improve unit economics. And this relates, I think, to Cam's presentation. Which are the most successful alternative revenue sources? And there's also some questions around certain target margins, which obviously relates to unit economics. What kind of gross and net margin should you aim for in order to become profitable with this business model? So a couple of questions there on the same theme.
Thanks so much for the questions and thanks for relaying them, Frida. So I'll start with the last question, right? What kind of ranges of gross margin do you look at? I think typically, at least, for us, and I think it's a bit, you typically want to see a business that is somewhere around 50% or more, right? Gross margin, because remember what is gross margin, right? Is how much money is left that you've paid for the good, right? If you have been running a business that, often it's, you're left with, I don't know, 20, 30% gross margin, often it raises questions around how sustainable that might be, right? Because it's suggesting it's something quite expensive, right? So I would say in terms of those target, but at least from our perspective as sort of a company that, does sort of early stage investment, we typically like to see, 50, 60%, right? And the assumption here often is that over time that improves, right? That as you're sort of buying more units, as you're selling more over time, you're able to sort of improve that. That sort of question then leads me to the second one you asked around how do you improve your unit economic, right? I think a lot of times, right, in a very strange way, it's growth, right? That the more you grow, often your unit economics might become better, because if you think about, let's say you set up a business to sell, I'll make up, a bottle that, provides light at night, right? It's an amazing bottle that you buy, provides light at night after storing energy all day. What you would tend to do is that in the beginning, what you're paying for that bottle, you might be selling it for, you can use US dollars, just for convenience, and say that bottle you're selling for 100, right? You're able to buy it for 50. Now that 50 might be because, well, you've projected right now when you went to your supplier, you convince them, they're like, look, you're new, I can't give you anything less than that. Right? You grow your business, you get to the point where you're selling, 1,000 of those bottles every year, right? With that, you can typically get a kind of discount, right, from your supplier that might allow you to, now buy at $40 per bottle, right? It doesn't mean that essentially your gross margin is now gone from 40%, right, to 60%, right? So that's sort of like, one way is like when you grow your business well, right? Your unit economics will typically improve, or you figure out a way to charge more to your consumers, right? So it could be that you need to relook at the kinds of products you're selling, right, or the kinds of segments you're selling to. So those are different ways to think about how do you improve your unit economics. Now the flip side of that question, I think, is also right, because at the end of the day, unit economics is about sustainability, right? It's around seeing like does the unit economics make sense for the kinds of operational OPEX costs you're going to incur? And I think that's sometimes overlooked, that there tends to be a view, at least in my opinion, where people tend to look at operating costs, OPEX costs as fixed, right? Like they're not fixed, right? If you have a business that has low, unit economics, right? Whether it's your contribution margin, your gross margin, what I would suggest to you is sort of look and say, how do you optimize, right? Like your operating expenses to make sure that they fit within the kind of unit, right? So in a way, unit economics on its own, it's not the be all and end all, right? The importance becomes when you start thinking about other costs. Remember, that's the value is, well, if I am running a business, where my unit economics are, let's say, on that $100, it's $50, right, that I'm earning, so 50%. And my operating expenses are $1 million, right? That's telling me that effectively I need to be having, somewhere around 20,000 units, right, in market every year to be able to cover that operating expense. But I could relook and see, do I, should I be running a more lean business, right? Should I be able to do with, I don't know, 100,000 to start off with, so that it's closer, to 200 units or something, or 20,000 units for what I'm doing. So I think, again, great question, right? That like, ways to improve as you get bigger, you probably get better deals with your suppliers. You might want to look at, are you serving the right segment of the market, right? Are you folks, are you pricing well? right? But the flip side of that is that, you know, you want to make sure that you are also looking at your operating expenses, right? That, you know, your unit economics could be terrific. It could be even 80%. But if you are running a massive operation that eats up all of that, then, you know, it may not be a good business. The last question I think, Frida, you asked was around, you know, what are alternative sources of revenue? That's, I think, a business secret question, right? I think that's sort of, I think what we see as part of the job of the entrepreneur, right? That you own your market, you know your market, and you're able to come up with things that make sense. But that being said, we will say what we are seeing, at least in the market, is that there is a shift towards what you might call kind of more productive use energy. And I think that's a word that, you know, Lovemore kind of used during, you know, his comments, that there is a shift towards looking at perhaps what do you invest in, what do you sell that people can use to generate an income that makes it easier for them to pay you, right? Because at the end of the day, you know, you can sell a lot of things, right? Especially in PAYGO, you can sell pretty much anything, but the question then becomes, is this something valuable enough to the customer that they will make payments? And one way to think about it is, are you investing, providing with something that is a productive asset to them, right? That if it's something, for example, that helps keep my shop open for 3 hours more a day than otherwise, or keeps thieves away or something, then I'm willing to pay perhaps a bit more for that than I would be maybe for something that might just help keep my lights on, right? Again, just some thoughts, but I think those are the things that you as an entrepreneur, right, bring to the table in terms of knowledge of your market, knowledge of your customers, that helps you get a sense of what makes sense for the kinds of context you're operating in that can improve, right? That can be a good alternative source of revenue.
Thanks, Toukan. Very interesting views there. And next couple of questions also relates to that, and also actually much subject of discussions over the last couple of years, and relates to profitability and scale, and the questions around when is it realistic to break even and become profitable in the PAYG context, and yeah, can it be defined in how many years, certain amount of customers, amount of revenue, and in a PAYG business model context? So perhaps your perspective on that.
Yeah, so I think this is a bit related to what Toukan already mentioned when it comes to unit economics and operational efficiency. I mean, I think, yeah, generally there is no number of customers that is true for all businesses, or number of years that is true for all businesses, right? But I think definitely what has been taken companies longer than initially expected is, among other, also the operational efficiency. So I think on the one, and so it depends on, like, first of all, of course, what is your gross margin on the unit, but then also how efficiently can you run the operations. And then when it comes to how many years it will take to break even, that's also yeah, basically how quickly can you scale. So I think there's different variables that play into that. Definitely the macro environment, the geographies. So I would say there is no right answer that is true for all businesses, but it really depends on yeah, mainly the operational efficiency, the unit economics, and all then also the I would say the effectiveness of the sales organization in scaling the business, in acquiring new customers with a good portfolio quality.
Thanks, Eva. And I think we have also time for a couple of questions around different valuation approaches and valuations in the sector. And there's one question here on what valuation approach is the most preferred. Is one model preferable over another, especially in the context of early stage businesses? And I think you've touched on this a little bit already.
You know, thanks for that question. I think I can sort of take that up. So, you know, valuation is complicated business, right? I think let me start with that. I mean, it's often like it's a very complicated business. So remember what this is doing, and I think Eva touched on quite well, was that, you know, she provided a bunch of different kinds of valuation. So if we're to go back to sort of that question around, hey, look, for what valuation makes sense. I'd say, in my view, it largely depends on the stage where you are, right? That when you're early stage business, typically pre-revenue or very sort of, revenue is not big enough. I think in that case, I think what you mentioned, the Silicon Valley rule, right? That tends to be the case, right? Where what tends to happen is that depending on what you're trying to raise, the percentage you're willing to give up, right? It gives you a sense of what value your business might be worth. But then remember, there's the flip side of investor, right? That I think that's where valuation in a way is a negotiation at that stage, because the investor might also have a certain amount of money that saying, okay, this is what you want, right? I'll make up an example here. I would say, look, you're looking for 100,000 to kick off your business, right? This is sort of a pre-revenue business, and you're willing to give up, I don't know, say 5%, and you say, look, for that 100,000, you're willing to give up to 5% of your business, right? That would suggest your business is what times 20, that's about 2 million, right? But an investor on the flip side might say, look, I'm willing to give you the 100,000. I think it's a great business, but I want maybe 10% of the business or 20% of the business, right? So I think, again, at the early stage, it is largely a negotiation, and it is based on what you're willing to give up, what they're willing to accept, and what they're willing to get. But I think Eva touched on it, soft factors like, what is the quality of the management, right? These folks who have invested in a business, who have run a business before that is close enough, right? Is there a track record here, right? Is the business, is it meeting some particularly unique need in the market? Is it a segment that's unserved? Is this a region that is unserved? So those are the things that at that early stage comes in. Once you start having a business that, is generating quite a bit of money and has some kind of EBITDA, then what Eva talked about, like discounted cash flow, then becomes something that, a bit more used, because it's like, okay, now, there's some actual revenue, there's some trends we're seeing that can help us get a sense of where this business might be headed towards in terms of a discounted sort of a cash flow perspective. That, that's where you said saying sort of a discounted cash flow perspective becomes useful. The multiples method she talks about, that honestly, I think, as she said, is often a challenge in this sort of market we're in, because you don't see a lot of those sales happening. Because if you think about your multiples method, it is fundamentally just saying, look, a company that might be similar has been bought out, and this is what investors paid for it. When you compare it to what the EBITDA of that company was, or the revenues, or maybe the number of customers, this is what the value is, right? That's the whole multiples approach, right? Multiple approach doesn't tend to be very common because of the market we're in. DCF, discounted cash flow method, becomes valuable once the business is up and running, as has some good cash. But at a very early stage, DCF can come in, but what we typically see is a lot more around just this is what you need. This is a stake that you want to give up, or the person investing wants to get. These are the other things that are taken into account. Like, well, okay, right? You are very experienced, so okay, we believe this is gonna, so some of those more soft factors.
Thanks, that's very helpful. And I think we have time for a last question. And this is a very broad question, and you won't have too much time to answer it, but it's about the development of valuations in the sector and what you see the main drivers of valuations, and perhaps also mistakes and misconceptions around modeling the valuations in the sector.
So yeah, I think I'll start with the last one that you mentioned, the mistakes and misconceptions. I think one of the mistakes or misconceptions that we've seen is that the higher the better, right? And this is something that I briefly touched upon before, is that it's not always, you need to keep in mind also that that you might want to fundraise in future. So and there what you want to is to avoid the down round. And I think another one is that some of the assumptions are overly optimistic, and that obviously also drives up the valuation. I think that's mainly from my side on the main misconceptions or mistakes. And then I think the other question was around the drivers. I think we touched a lot upon those, but essentially it's the view that you have on the potential of the business to generate cash in future. And there's several aspects that play into that. It's the unit economics, it's the operational efficiency, it's also the growth potential, which depends on the market environment, on the value proposition of the company. So I think several aspects, and then obviously the cost of capital is also something that plays into it. I think that's mainly it.
Thanks, Eva and Tokam. I think we have much food for thoughts through the Q&A session, and thank you everyone for posting the questions. And yeah, we also have some questions around where this will be available, and we will circulate the questions and answers after the webinar for everyone who's registered. And you can also get in touch. I think that's on the next slide, through the Access to Finance email, if you have any further questions or comments. And once again, thank you, Eva and Tokam, for your presentation and for your work with the development of this model. And also thank you everyone for taking time to attend and listening in to this webinar series. We know this is very busy times for everyone. And so we hope that this tool will be helpful for not only entrepreneurs, but also other stakeholders in the sector. And with that, I will end this webinar, and I wish you a very good rest of the week. Thank you.
Thank you, Frida.
Thank you, Frida. And thanks everyone for attending.
We really appreciate your time.